Hello traders, and welcome back to the Com Lucro channel. Today, we're continuing our technical analysis for day traders course by exploring one of the most important concepts in trend trading, continuation chart patterns. In the previous video, we covered reversal patterns such as the head and shoulders and double tops, which help identify when a trend may be losing strength. Now, we'll focus on the opposite situation, how to recognize when a pause is only temporary and the current trend is preparing to continue. In this video, you'll learn how chart patterns reflect the balance between buyers and sellers, and how to identify the flag, pennant, rectangle, ascending triangle, and descending triangle. We'll examine how each pattern forms, what confirms it, and how traders can use it to find opportunities aligned with the dominant trend. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Now, let's begin by understanding why continuation patterns are so important. These patterns help confirm the strength of an existing trend by showing that price may be taking a temporary pause before continuing in the same direction. Recognizing these moments can improve your timing and help you stay aligned with the prevailing trend. Strong trends rarely move in a straight line. Instead, they alternate between expansion and contraction. When price slows down and volatility decreases, the market may be building momentum for the next impulsive move. Continuation patterns often form during these pauses, suggesting that the trend may be preparing to resume. Unlike the reversal patterns covered in the previous video, continuation patterns indicate that the current trend may continue after a temporary consolidation. We'll examine their main characteristics, confirmation signals, and practical use through real market examples on TradingView. These patterns apply across platforms, although chart data and drawing tools may differ slightly. So, what are continuation chart patterns? They are formations that represent a temporary pause within an existing trend, suggesting that price may continue in the same direction afterward. They are especially useful for day traders because they help confirm that an uptrend or downtrend may still have momentum. At their core, these patterns reflect consolidation rather than a reversal in market sentiment. In an uptrend, buyers may pause to consolidate gains before pushing higher. In a downtrend, sellers may pause before driving price lower. These periods can create opportunities to enter trades aligned with the dominant trend once the pattern is confirmed. Let's explore the bull flag and bear flag patterns. These patterns typically form during strong trends and signal a brief pause before the trend resumes in the same direction. A bull flag forms during an uptrend, indicating a temporary consolidation before the upward movement continues. It features a sharp price rise, the flagpole, followed by a consolidation phase, where the price moves within a downward sloping channel, the flag. A breakout above this channel confirms the continuation of the uptrend. In contrast, a bear flag occurs in a downtrend, where the price consolidates within an upward sloping channel before breaking down, signaling the continuation of the bearish movement. To spot a flag, look for a strong price movement followed by a consolidation phase. The breakout from this consolidation confirms the continuation of the trend. The breakout is crucial, as it marks the point where buyers regain control in a bull flag, or sellers in a bear flag, signaling the end of the consolidation and the resumption of the original trend. As you can see on the Bitcoin against the US dollar chart, the market is in a strong uptrend and begins forming a bull flag pattern. First, notice the sharp rise in price, forming the flagpole, a rapid upward movement fueled by strong buying momentum. After this rise, the market enters a consolidation phase, where the price moves within a downward sloping channel, forming the flag. During this period, the price remains confined within a narrow range, reflecting a temporary balance between buyers and sellers. However, this phase is merely a pause in the trend, and it's essential to watch for the breakout. Now, as the price approaches the upper boundary of the flag, watch closely. Once it breaks through this resistance, we have clear confirmation of the bull flag pattern, signaling the continuation of the uptrend. Traders often use this moment to enter positions, taking advantage of the resumed upward momentum. Similarly, with a bear flag, the market experiences a sharp drop in price, forming the flagpole during a downtrend. Following this decline, the price consolidates in an upward sloping channel, indicating a brief retracement. As the market gathers momentum, it's crucial to monitor the lower boundary of the flag. When the price breaks below this support, we have confirmation of the bear flag, signaling the continuation of the downtrend. Traders can use this as an opportunity to enter short positions, expecting further declines. Let's now explore the pennant, another important continuation pattern in trading. The pennant forms during strong trends and signals a brief pause before the trend resumes in its original direction. It resembles the flag, but differs in that the price consolidates into a small symmetrical triangle rather than a sloping channel. The pennant represents a temporary indecision in the market before the continuation of the prior move. In the case of a bull pennant, the formation occurs after an upward price movement. First, there is a sharp price increase, creating the flagpole. Then, the price enters a consolidation phase, where the highs and lows converge, forming the triangle. A breakout above this triangle confirms the continuation of the uptrend. For a bear pennant, the same principle applies, but in a downtrend. After a sharp drop, the price consolidates into a triangle before breaking downward to resume the bearish movement. To identify a pennant, look for a strong directional move, followed by a triangular consolidation. The breakout from this consolidation confirms the continuation of the trend. The breakout is crucial, as it marks the point where buyers regain control in a bull pennant, or sellers dominate in a bear pennant, signaling the end of the consolidation and the resumption of the trend. Now, as seen on the Bitcoin against the US dollar chart, the market is in a strong uptrend and begins forming a bull pennant. First, there's a sharp upward movement, creating the flagpole. Then, the price consolidates into a triangle as the highs and lows converge. During this phase, the market reaches equilibrium between buyers and sellers, but this pause is only temporary. Watch as the price approaches the upper boundary of the triangle. Once it breaks through this resistance, we have confirmation of the bull pennant, signaling the continuation of the uptrend. Traders often enter positions at this point, taking advantage of the resumed upward momentum. Similarly, in a bear pennant, the market experiences a sharp decline, forming the flagpole. After this drop, the price consolidates into a symmetrical triangle. When the price breaks below the support line at the triangle's base, the bear pennant is confirmed, signaling the continuation of the downtrend and offering short selling opportunities. Let's now dive into the rectangle continuation pattern. The rectangle pattern forms when the price consolidates between two horizontal levels of support and resistance. Unlike the flag or pennant, which have sloping channels or triangles, the rectangle shows a period where the price moves sideways in a clear range before breaking out in the direction of the prior trend. It's a straightforward yet effective pattern that signals the continuation of the existing trend, either bullish or bearish. In a bullish rectangle, the pattern appears after an upward move. The price oscillates between a horizontal resistance at the top and a horizontal support at the bottom, forming a rectangular shape. The breakout above the resistance signals that the uptrend is likely to resume. Conversely, a bearish rectangle forms after a downward move, with the price consolidating between horizontal support and resistance levels. A breakout below the support confirms the continuation of the downtrend. To spot a rectangle, look for a trend, followed by a consolidation phase where the price moves sideways within a defined range. The breakout, whether upward in a bullish rectangle or downward in a bearish rectangle, confirms the continuation of the trend. The breakout is critical, as it shows when the market has decided its direction after the period of consolidation. In a bullish rectangle, buyers regain control once the price breaks above resistance, while in a bearish rectangle, sellers dominate when the price breaks below support. Now, let's look at an example of the bullish rectangle on the Bitcoin US dollar chart. The market is in a strong uptrend before entering a bullish rectangle. After a sharp upward move, the price consolidates between a resistance level at the top and a support level at the bottom, forming a clear rectangle. During this phase, the price fluctuates within this range, showing indecision between buyers and sellers. However, this sideways movement is only temporary. As the price approaches the upper boundary of the rectangle, watch carefully. Once it breaks through this resistance level, the bullish rectangle is confirmed, signaling that the uptrend is likely to continue. Traders often look for these breakout points to enter long positions and capitalize on the continuation of the bullish trend. Similarly, in a bearish rectangle, after a significant downward move, the price consolidates within a horizontal range. When the price breaks below the support level, the bearish rectangle is confirmed, signaling a continuation of the downtrend and offering an opportunity for traders to enter short positions. Let's explore the ascending triangle and its counterpart, the descending triangle. These two patterns form during trends and indicate a potential continuation of the current direction after a period of consolidation. The ascending triangle is considered bullish, while the descending triangle is typically a bearish continuation pattern. In a bullish ascending triangle, the price forms a series of higher lows, while the highs hit a flat resistance level. This creates a triangle shape, as the rising trend line converges with the horizontal resistance. The pattern indicates that buying pressure is increasing as the market keeps pushing higher, leading to an eventual breakout above the resistance line. In contrast, a bearish descending triangle forms during a downtrend. In this case, the price creates lower highs, but the lows hit a flat support level. The descending trend line shows growing selling pressure, and once the price breaks below the support level, it confirms the continuation of the downtrend. To identify these patterns, keep an eye out for the following. In an ascending triangle, look for rising lows paired with a flat resistance level at the top. For the descending triangle, watch for lower highs with a flat support line at the bottom. The breakout is key in both patterns. In the ascending triangle, buyers eventually overpower the resistance, signaling the continuation of the uptrend. In the descending triangle, sellers break through the support, confirming the continuation of the downtrend. Now, let's look at an example of the bullish ascending triangle on the Bitcoin against the US dollar chart. The market is in an uptrend and begins consolidating. The price forms higher lows, but each rally meets resistance at a horizontal level, forming the ascending triangle. As the price consolidates and gets closer to the breakout point, buyers keep gaining strength. When the price breaks through the resistance, the pattern is confirmed, signaling the continuation of the uptrend. Similarly, in a bearish descending triangle, the price is in a downtrend and begins consolidating. It forms lower highs, but the lows find support at a flat level. As selling pressure increases, the price eventually breaks below the support level, confirming the descending triangle and signaling the continuation of the downtrend. Now, let's examine the main benefits and risks of continuation chart patterns. These patterns help confirm that an existing trend may still have strength by showing periods of consolidation before price potentially continues in the same direction. Flags, pennants, rectangles, and triangles can also highlight entry opportunities and help traders define entry, stop loss, and target levels more objectively. However, continuation patterns are not guaranteed to work. False breakouts can occur when price briefly moves beyond the pattern before reversing. News events, economic releases, and sudden volatility can also invalidate a strong-looking setup, which is why the broader market environment must always be considered. Another limitation is that confirmation may arrive late. Waiting for a clear breakout can reduce uncertainty, but it may also mean entering after part of the move has already happened. Entering too early creates the opposite problem, because an incomplete pattern may develop into a longer consolidation or fail completely. Traders should avoid relying on the pattern alone while ignoring the higher timeframe trend, support and resistance, volume, or overall market conditions. They should also remember that live breakouts are rarely as obvious as they appear on historical charts. Price may hesitate, reverse, or produce false signals before choosing a direction. The best approach is to wait for confirmation, evaluate the broader context, and define the trade before entering. Continuation patterns work best when combined with market structure, volume, higher timeframe analysis, and disciplined risk management. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the Com Lucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the Com Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.